Welcome to the Deep Dive. Today we're digging into Alcoa Corporation's first quarter 2025 earnings call.
That's right. We'll break down the numbers, look at what management had to say, that's CEO William Oplinger and CFO Molly Burman.
And we'll get you the core insights. Then stick around for our This Is Not Financial Advice segment where we toss around a potential trade idea.
Sounds good. So let's start with the headline results for Q1.
Okay, lay it on us.
All right. Revenue saw a bit of a dip, down 3% from the previous quarter, came in at $3.4 billion.
Okay, down 3%. But I heard the profit picture was better.
Much better, yeah. Net income attributable to Alcoa, it really surged, jumped up to $548 million.
Wow. Compared to what?
Compared to just $22 million in the prior quarter, so a huge improvement.
And earnings per share?
More than doubled, hit $2.70. On an adjusted basis, net income was $568 million, or 2.15 per share.
Okay, so revenue down slightly, profit way up. What caused that big jump in profitability?
Well, the big story is adjusted EBITDA. It increased by a substantial $178 million.
Bringing it to
$855 million total. And this was mostly driven by higher aluminum prices, which is obviously good for them.
Right.
And also lower intersegment profit elimination. That's basically internal accounting stuff, making the external profit look cleaner.
Okay, so those were the positives. What offset that?
Well, those gains outweighed the drag from lower alumina prices during the quarter.
Got it. So it sounds like the different parts of Alcoa's business had varying results.
Exactly. If you break it down by segment, the alumina business actually saw its adjusted EBITDA decrease.
Oh, okay. By how much?
Down $52 million. And that was mostly because of those lower alumina prices we just mentioned.
Anything else?
Yeah, also lower sales volume and some, unfavorable currency exchange rates hitting them.
And the aluminum segment, they must have benefited from higher aluminum prices.
They did benefit from higher metal prices, yes. And they got a bit of a tailwind from currency, too.
I sense a but coming.
But yeah, their adjusted EBITDA still decreased by $60 million.
Why was that? If prices were higher?
It was costs. Higher costs for alumina, which is their main raw material, plus increased production costs, energy, other raw materials.
So input costs went up significantly.
They did. And crucially, that $60 million decrease included about $20 million just for those U.S. Section 232 tariffs on Canadian aluminum.
The tariffs. I need to circle back to those. Okay, so beyond the financials, what about operations? Any highlights there?
Operationally, they started by emphasizing safety. Good news there. No fatal or serious injuries in Q1.
Always good to hear in that industry.
Definitely. They also reported pretty solid production across most sites, actually saw sequential improvement on a tons per day basis.
Okay.
And the Alumar smelter down in Brazil, it's continuing to stabilize, now running at about 91% capacity.
That's positive progress for Alumar. What else stood out?
Well, they completed a big debt deal in Australia, a $1 billion offering.
What was the purpose of that?
Mostly to pay back existing debt and push out their maturity dates. The key thing is they managed to do it at a lower after-tax interest expense.
Smart move, managing the balance sheet.
And one more big one. They finalized that joint venture with Ignis EQT for the San Ciprian operations in Spain.
Right, the smelter restart.
Exactly. This JV paves the way to get that smelter running again after it was idled.
Okay, let's maybe circle back to the financials then. We got the headlines, but can we dig a bit deeper into what drove those numbers?
Sure. That big jump in net income, like we said, was mainly higher aluminum prices and less intersegment profit stuff.
Right.
But the drags were significant too. Increased alumina costs really hurt, and as we mentioned, those U.S. tariffs on Canadian aluminum took a bite.
And unpacking the segment, EBITDA declines again. Alumina first.
For alumina, it was pretty straightforward.
Yeah.
Lower prices for their product, selling less of it, and currency headwinds making international sales worth less in dollars. Their cost control helped a bit, but not enough.
And aluminum, despite higher prices.
Yeah, for aluminum, it was all about the cost side. Paying more for alumina feed, more for energy, more for raw materials, general production costs. It just chewed through the benefit of higher selling prices and favorable currency.
Okay. They also mentioned working capital increased. What's the story there?
Yeah, working capital went up. That usually means more cash tied up in operations. In their case, it was mostly higher inventories.
Why the inventory buildup?
A few reasons. Higher prices for the raw materials they hold, just having more volume on hand. And also the timing of shipments played a role. Interestingly, their accounts payable actually went down.
Okay. And you mentioned that Australian debt deal that's part of actively managing their debt, right?
Absolutely. That $1 billion issuance and then using funds to tender for $890 million of existing notes, that's all about improving their financial position.
How so?
They extend the repayment timeline, so less near-term pressure, and they lock in lower interest costs after tax. It strengthens the balance sheet.
Makes sense. Okay, let's pivot to the future. What did management say about capital allocation and their outlook?
Their capital priorities haven't really changed. Focus is on keeping a strong balance sheet and funding the operations.
Do they have specific targets?
They do. They're aiming for adjusted debt, which includes pension liabilities and stuff, in the range of $2.1 to $2.5 billion.
And cash.
Target cash balance of $1 to $1.5 billion. So that puts their target for adjusted net debt minus cash at $1 to $1.5 billion.
Where are they now on net debt?
End of Q1, it stood at $2.1 billion. So they're a bit above the top end of that target range right now.
Aiming to bring that down then. What about specific forecasts for, say, Q2 or the full year?
They updated their full year 2025 depreciation expense outlook slightly, lowered it from $640 million to $620 million.
Why the change?
Mainly due to favorable currency impacts expected in Q2.
Okay. And segment performance outlook?
Alumina segment is expected to basically maintain its strong Q1 performance into Q2.
Good for them. Aluminum.
Aluminum segment, not so much. They're actually forecasting an unfavorable performance swing of about $15 million in Q2 compared to Q1.
Ouch. Why the expected dip in aluminum?
Two main things they called out. First, those U.S. Section 232 tariff costs on Canadian aluminum are expected to jump significantly. They estimate about $90 million higher sequentially.
90 million. Wow. Okay.
Yeah.
That's huge.
Yeah. And second, they expect about $15 million in operating costs related to restarting that San Ciprian smelter as it ramps up.
Right. Restarts aren't cheap. It really hammers home how much those U.S. tariffs are impacting things.
It's a massive factor. Now, on the flip side, lower average alumina prices, while bad for the alumina segment's earnings, will actually help the aluminum segment's costs.
Because it's an input cost for them.
Exactly. They estimate that benefit at around $165 million in lower alumina costs within the aluminum segment.
Okay. Any other outlook points?
Yeah, a couple more. They expect losses from equity investments to increase by about $10 million in Q2. Q1 had a one-off currency gain that won't repeat.
All right.
But on a brighter note, based on recent pricing, they're actually expecting a tax benefit in Q2.
A benefit? How
Yep.
much?
Somewhere between $50 and $60 million. They said this includes some timing and catch-up adjustments linked to those lower alumina prices impacting the year's tax calculations.
Interesting. Okay, let's really unpack these U.S. tariffs. You mentioned Section 232. What happened exactly?
So in March, the U.S. brought back the Section 232 tariff on Canadian aluminum, took it from 10% back up to 25% and got rid of the exemption.
And the cost Alcoa.
They estimate it's a $400 to $425 million hit annually. That's a big number.
Huge.
Yeah.
Does the higher U.S. aluminum price, the Midwest premium, offset any of that?
It offsets some of it, yes. The premium has gone up. But Alcoa reckons the net negative impact on them is still around $100 million a year.
So they still lose out significantly. What about other tariffs?
Things like AEPA tariffs or reciprocal tariffs aren't having a huge impact right now, they said, except for some reciprocal tariffs on input materials they get from China.
Why is that an issue?
Because they say there aren't really suitable replacement suppliers, so those tariffs are expected to add maybe $10 to $15 million annually to their costs.
It sounds like these tariffs create some real structural issues for the U.S. aluminum market itself.
It does seem that way. Alcoa made the point that the U.S. imports a ton of primary aluminum from Canada.
Right.
And even if every single U.S. smelter ran flat out, there'd still be a big supply gap. And building new smelters, that takes a lot of time and energy infrastructure.
So what are they doing about it?
They're actively talking to both the U.S. and Canadian governments, policymakers, trying to advocate for a better outcome. But it's a tough situation.
No doubt. Okay, shifting focus slightly. What about the wider market conditions for alumina and aluminum? What trends did they discuss?
For alumina, prices actually came down in Q1 2025. That's after hitting an all-time high late last year.
Well, drop.
A few things. More supply coming online from Chinese refineries ramping up, production outside China getting back to normal, and just, softer sentiment globally with economic uncertainty.
Is supply stable going forward?
Still some question marks around planned expansions in Indonesia and India. But interestingly, the current dynamic, high bauxite costs, lower alumina prices, is really squeezing Chinese refineries.
How badly?
They estimate over 80% of Chinese refineries are actually unprofitable right now, which could mean production cuts there. Plus, the Chinese government is apparently getting tougher on approving new alumina projects.
Does Alcoa's setup help them navigate this?
Yeah, they highlighted their global refinery network. It gives them supply security for their own smelters and customers, and they actually managed to cash in on high bauxite spot prices in Q1.
Okay. And the aluminum market itself, LME prices.
LME aluminum price was pretty resilient in Q1, but it did dip a bit after those tariff announcements.
And the Midwest premium, that U.S. price indicator.
It went up, like we said, but maybe not as much as some analysts thought it would need to make shipping aluminum from anywhere into the U.S. fully profitable.
Why not?
Could be ongoing uncertainty, maybe some inventory buildup in the U.S. before the tariffs hit. Hard to say for sure.
Any bright spots on the demand side?
They noted some support, Chinese stimulus measures, maybe some fiscal loosening in Europe helping things. On the supply side, growth was limited. Smelter ramp-ups were kind of balanced out by closures elsewhere.
What about their own product sales?
North American shipments of their value-added products were up, but it's unclear if that was just companies stocking up before tariffs. European volumes were down slightly quarter on quarter, but up year on year.
Any specific sector impacts?
Yeah, the foundry order book, which ties into the auto market, definitely took a hit from the tariff situation.
And San Ciprian fits into this broader picture how?
That restart, supported by the Ignis EQT joint venture, is about bringing idled European smelting capacity back online. Remember, it was shut down in 2021, mainly due to those crazy high energy prices then.
So overall, what's Alcoa's strategy in this complex environment?
It seems to be. Keep operations running strong, navigate the market uncertainty, and leverage their strengths. Their global footprint, relatively low-cost assets, long-term contracts, their low-carbon aluminum products, a decent cash balance, and, their track record of managing costs and making strategic moves.
Okay, let's dig into some specifics that came up in the Q&A. You mentioned San Ciprian restart costs. Can we get more detail on that?
Sure. They put some numbers on it. The expected negative cash flow impact in 2025 from the smelter restart is $90 to $110 million.
And the impact on earnings? Adjusted EBITDA.
Estimated loss of $70 to $90 million for 2025 from the smelter. They have put hedges in place for 2025 through 2027 to try and manage the financial risk within their funded plan.
Why are the losses expected to be worse in 2025?
Just restart inefficiencies, basically. Getting everything ramped up smoothly takes time and money. They haven't given 2026 numbers yet.
Any news on that restricted cash they had tied to the restart?
Yeah, about $12 million has been released. They're talking about getting the rest, around $75 million released too. But about $50 million of that is tied to an anode bake furnace rebuild that isn't actually planned until after 2027.
So the release funds will cover ongoing restart costs.
That's the idea, yeah. It comes in as spending happens. And important note that $90 to $110 million cash burn guidance, that's just for the smelter.
What about the refinery there?
It was near break even, but with lower alumina prices now, they expect the refinery to slip into a loss position as well.
Okay. Any other interesting tidbits from the Q&A?
A few things. On the alumina market, they're seeing Chinese refineries take longer maintenance shutdowns because of the poor economics. Suggests a quick reaction to unprofitable conditions.
Right.
And while they took advantage of some bauxite spot market opportunities in Q1, they don't really see it making sense to cut their own alumina output just to sell more raw bauxite. The marginal cost of running their refineries is pretty low.
What about input costs going forward? Any specific mentions?
Yeah, they flagged about a $5 million expected increase in caustic prices for Q2. And similar pressure, around $5 million, on coke prices on the smelting side.
Are those included in their guidance?
No, they expect to offset those with productivity gains, so they weren't baked into the main outlook numbers.
Okay. And working capital? It was higher than expected in Q1.
It was, yeah. But they see it coming down significantly through the rest of the year. Expect a big drop in Q2, actually, tied to shipment timing, higher prices moving inventory, and using up some raw materials.
And that Q2 tax benefit, just to clarify, does that mean they expect to lose money pre-tax in Q2?
Not necessarily, no. They explained it's mainly a catch-up adjustment because lower alumina prices affect the year-to-date tax math, especially after strong Q1 earnings. They still expect regular tax expense on whatever Q2 earnings they generate.
Got it. And more on those tariffs, again, the Midwest premium sensitivity.
Yeah, they acknowledge the premium hasn't reacted as strongly as maybe theory would suggest to the 25% tariff.
Any reason why?
They think it's likely uncertainty around the tariffs themselves, plus maybe that inventory stockpiling that happened beforehand in the U.S.
And their $100 million net negative impact estimate, what's that based on?
That compares a pre-tariff premium of around 24 cents a pound to the current level around 39 cents.
What do they think the right premium should be with a 25% tariff?
They estimate an equilibrium level would be somewhere between $880.60 and $990 per ton. So quite a bit higher than where it is now.
Okay. Any quick updates on anything else from Q&A? Australia permitting potential EU tariffs.
Permitting in Western Australia is moving along as expected, public comment period coming up soon. As for potential EU trade actions in response to U.S. tariffs, too much uncertainty to speculate, they said.
Right.
The U.S. Section 232 is somewhat settled, but other potential tariffs are still question marks. They did point out their European smelters, Norway, Iceland, and soon Spain, contribute to regional capacity. And San Ciprian restart, despite the cost, is driven by a contractual obligation.
Okay, that is a very thorough breakdown. Fantastic. Now let's transition to our This Is Not Financial Advices segment. Time for some creative thinking based on all this.
All right, let's brainstorm. So the big elephant in the room is clearly those U.S. tariffs on Canadian aluminum.
Ah, definitely. And Alcoa has significant Canadian production feeding the U.S. market.
Right. And we just heard the Midwest premium hasn't fully compensated for that 25% tariff yet. That creates a potential imbalance, doesn't it?
How so?
Well, U.S.-based producers, those with mainly domestic smelting, they get the benefit of that higher Midwest premium, but they don't face the same direct tariff hit on imported metal from Canada that Alcoa does.
So an outrageous but plausible trade idea could be playing that divergence.
Exactly. Highly speculative, mind you. But one idea could be a pair trade. Go long shares of a primarily U.S.-based aluminum smelter and simultaneously go short Alcoa stock.
The thesis being the U.S. player benefits more from the current tariff structure, while Alcoa faces the direct headwind.
Precisely. You're betting that the market hasn't fully priced in this differential impact yet, and their stock performances might diverge in the near term because of it.
Okay, that's definitely thinking outside the box. What's another one? It's on another angle.
How about focusing on the alumina market dynamics? We talked about the squeeze on Chinese refineries.
Right. High bauxite costs, low alumina prices, making over 80% unprofitable, plus tighter government scrutiny on new projects.
Yeah, that potentially points to future constraints on alumina supply coming out of China, right? If they have to cut back production significantly.
Okay. So where's the trade?
Well, if Chinese alumina production gets constrained, where does the world get its alumina, or the raw material for it? Bauxite.
From outside China.
Exactly. So a different kind of speculative, maybe longer-term idea. Take a long position in a bauxite mining company, specifically one with significant reserves and operations outside of China.
So the logic is constrained Chinese alumina output could boost demand and pricing power for non-Chinese bauxite.
That's the thesis. If Chinese refineries cut back, the miners supplying bauxite elsewhere might see increased demand, potentially pushing up bauxite prices and benefiting those mining companies. It's an indirect play on potential shifts in the global supply chain.
Interesting. Two very different, outrageous but plausible ideas there. And a strong reminder, folks, this is absolutely not financial advice.
Definitely not. Just brainstorming based on the call information.
Okay, that wraps up our deep dive into Alcoa's first quarter 2025 earnings. We've hit the key numbers, the operational updates, the huge impact of those U.S. tariffs, and the broader market picture for alumina and aluminum.
Plus, a couple of hypothetical trade scenarios just for discussion. Remember, do your own homework, your own due diligence.
Absolutely. What stood out most to you from Alcoa's call? What do you think about those trade ideas? We'd love for you to join the conversation. Let us know your thoughts.
Thanks for tuning into the deep dive.
We'll catch you on the next one.